Welcome back to the deep dive. So today is Wednesday, February 4th, 2026. And if you have been glued to the financial markets at all this morning, you might have noticed something that looks, well, a little weird.
Yeah, a little paradoxical.
The New York Times, the Gray Lady, the paper of record, just dropped their Q4 2025 earnings report. And if you only looked at the stock ticker, you would think the sky was falling. The stock closed down about 6.5%.
Which is a pretty ugly red line for a single day of trading, for sure.
Right. But, and this is really the paradox we're going to unpack today, if you actually download the PDF, you scroll past all the legal disclaimers, and you look at the actual numbers, the company is posting some of the best financial performance in its entire history.
Oh, absolutely. They're breaking records left and right.
So what's going on?
It's a classic case of the market's expectations getting slightly ahead of reality. But, frankly, the stock price volatility is the least interesting part of this story. What we're really looking at today is a blueprint. I mean, this isn't really a newspaper company anymore. This is a 175-year-old institution that has successfully morphed into a digital lifestyle giant.
That is exactly our mission for this deep dive. We're going to move past that red arrow on the chart and figure out how they pulled this off. We have a lot of ground to cover, but we're going to focus on three specific pillars.
Okay.
First, the bundle, or how playing word games and looking up pasta recipes is effectively subsidizing war reporting.
It is a fascinating economic model. I mean, it's pretty much what saved the company.
Second, we have to talk about a massive surprise in their advertising business. While the rest of the media world is panicking about ad revenue drying up, the Times is up double digits. We need to know why.
Spoiler alert, it has a lot to do with trust in a very messy internet.
And finally, we'll look at the next big pivot into video and a very clever strategy they have for password sharing. It's the carrot instead of the stick.
It is a dense report, for sure.
Yeah.
But if you read between the lines, it tells a very, very clear story about the future of information.
So let's start with the big picture. They released the numbers for the full year of 2025. What's the headline here?
The headline is Scale. Pure and simple. In 2025, the New York Times added 1.4 million net new digital subscribers.
Wow.
That brings their total subscriber base to nearly 12.8 million people.
Let's just pause on that for a second. 12.8 million. I mean, that is a massive number for a subscription service that isn't, Netflix or Spotify.
It is a staggering number, and you have to remember, a few years ago, they set this ambitious, almost crazy goal of reaching 15 million subscribers. Industry analysts laughed.
They did. They said news is a dying business.
Right, but now they are closing in on that 15 million mark rapidly. And financially, they crossed a massive threshold this quarter. For the first time in history, their total digital revenues passed $2 billion.
$2 billion just from digital.
Correct. And that is a huge psychological and financial landmark. You have to understand the context here. For 2 decades, publishers have been terrified of the transition from print to digital. The old saying in the industry was trading print dollars for digital dimes.
Meaning you make $1 selling a physical paper, but you only get, 10 cents for an online ad?
Exactly.
Yeah.
And that math killed a lot of newspapers. But this report proves that if you have enough scale, if you have almost 13 million people paying you, those digital dimes stack up into billions of dollars of real cash flow.
Okay, so they have the money, but the how is what really fascinates me. CEO Meredith Kopit Levien has been beating this drum for years now. She keeps saying the Times is not just a newspaper, it's an essential subscription for daily life. That sounds a bit like marketing speak, but what does it actually mean in practice?
It means they stopped trying to just sell you the news. If you were only selling news, you were selling a commodity. And worse, it's a difficult commodity. I mean, it is often depressing, sometimes terrifying, and it's highly seasonal. If there isn't a huge election or some natural disaster, people just tune out.
Yeah, if the news is quiet or if I'm just exhausted by the state of the world, I might not open the app. I might actually avoid it for my own mental health.
Exactly. And that causes churn, people canceling. So they redefine the product. When you look at the portfolio now, yes, it is the news, but it's also The Athletic for sports coverage.
Of course.
It is games, which we all know is a massive cultural force with Wordle and the mini crossword. It is cooking. And it is Wirecutter for shopping advice.
And this leads us to what I think is the most critical metric in this entire report, the bundle.
The bundle is the engine. It's everything. According to the data, 51% of their total subscriber base is now on the bundle. or a multi-product plan.
That is over half their users paying for that all-access pass.
Over half. And this is the real aha moment for their business model. It makes the entire business durable. Let's say it is a slow news week. Or maybe you were just burnt out on politics, which, let's be honest, happens to all of us.
Oh, for sure.
You might not read a single article about foreign policy, but you will almost certainly open the app to keep your Wordle streak alive. Or you'll check a recipe for dinner. Or see who won the Knicks game.
So the engagement doesn't drop off just because the world is quiet. It keeps you in the ecosystem.
Precisely. It creates a daily habit. You aren't just a newsreader, you are a user of the app. And that retention, that stickiness, allows them to do something that is incredibly difficult in the digital age: raise prices.
Okay, this is where we need to talk about ARPU. I know it sounds like a seal barking, but it's really important.
It is vital. ARPU stands for average revenue per user. It basically just answers the question, how much is the average customer paying us every month?
And for digital-only users, that number grew to, what, $9.72 a month?
$9.72.
Yeah. That feels pretty high for a media subscription. I feel like most people are used to paying, what, $5 or $6 for streaming services with ads? Nearly $10 for a newspaper app seems steep.
It is high.
Yeah.
And the CFO, Will Bardeen, he explained exactly how they achieved it. It is a strategy they call the step up.
The step up.
Think of it like a very polite version of a bait and switch. They get you in the door with those really cheap promotional rates. You've seen them, the $1 a week for your first year offers.
Oh, yeah. It's an irresistible deal.
It is. But then, when that year is up, the promo rolls off.
Yeah.
And they transition you to a higher price point.
And recently, they have even been raising prices on tenured subscribers, people who have been there for years.
Right. And here's the kicker. People aren't canceling. The fact that ARPU is going up means people aren't fleeing when that sticker shock hits. They're sticking around because they perceive so much value in the bundle.
Right.
You might cancel a new subscription to save $10, but are you going to cancel the thing that holds your grandmother's cookie recipe and your daily crossword streak?
Probably not. It creates a moat around the subscription.
A huge one. It diversifies their risk so they aren't live or die based on the news cycle.
Speaking of risk, there was an even bigger surprise in this report. One that I think speaks to the broader state of the internet right now. We have to talk about the ads.
The advertising numbers were genuinely shocking to almost every analyst who covers the stock.
I mean, we keep hearing that the digital ad market for publishers is dead, right? We hear that Google and Meta and Amazon eat everything, and there are only scraps left for everyone else.
That's the narrative.
But the Times reported that digital advertising revenue was actually up about 25% in the fourth quarter. That seems impossible.
It is a massive beat against expectations. In this polarized, low-trust environment where most tech platforms just dominate, seeing a legacy publisher grow ad revenue by a quarter is startling.
So why is this happening? Is it just that they have more inventory? And for our listeners, inventory just means blank spaces on the screen to put an ad.
That is part of it, yeah. When you have millions of people playing games and checking sports scores, you naturally have more blank spaces to put a banner or a video ad. So supply is up.
But that can't be the whole story.
No, the real story is about demand. Marketers are looking for safety.
Brand safety.
Exactly. I mean, think about the open web right now in 2026. It is a messy place. There is so much AI-generated slop, a lot of extreme content comment sections that are toxic, fake news sites. If you are a luxury car brand or a major bank, do you want your ad running next to a hallucinating chatbot or some conspiracy theory video?
Definitely not. You don't want your brand associated with that chaos.
So advertisers are fleeing to quality. They want to be associated with high-quality journalism and premium lifestyle content. They know that a New York Times reader is likely a real human being, not a bot, who is engaged and probably has disposable income.
And I imagine the data plays a huge role here, too. The Times has been very aggressive about getting people to log in. You can't really do anything on their site without an account now.
That's the third leg of the stool. Because they have direct billing relationships with almost 13 million people, they have what we call first-party data. They aren't relying on those creepy third-party cookies that follow you around the internet.
Which browsers are blocking anyway.
Which are all going away, exactly.
Yep.
They know what their users are reading, what they're buying on Wirecutter, what games they play.
So they can tell an advertiser, we can put this ad in front of a tennis fan who likes cooking Italian food without needing to track them across the entire web.
Precisely. They have developed these proprietary targeting tools. They call them canvases. And for advertisers, that is gold. Effectively, the Times has turned itself into a premium data platform. It's not just a place to print an ad, it's a targeted data ecosystem.
That is a defensive moat that smaller publishers just cannot build. You need the scale.
You need millions of users to make that data statistically significant. It really separates the winners from the losers in media today.
Okay, so the bundle is working, the ad business is booming, but they aren't just sitting still. The report highlighted a major strategic pivot for 2026, and it is all about video.
This is the next frontier. Meredith Kopit Levien was very clear about this in her remarks. They want to be the preferred brand for watching news, not just reading it.
Which makes sense, right? I mean, look at how people consume information now. It's YouTube, it's TikTok, it's Instagram Reels. But the Times has always been text first. It feels like a huge cultural shift for them.
They are trying to rewrite their DNA. They have launched a new Watch tab right in the app. And you should notice what they are putting there. It isn't just a reporter talking to a webcam in a dimly lit room.
Right.
They are investing in visual investigations, highly produced documentary-style pieces. They are turning their hit podcasts, like The Daily, into video shows.
That sounds expensive.
It is incredibly expensive. High-quality video requires cameras, editors, producers, on-air talent, studio space, and that actually connects to why the stock dropped, which we will get to in a minute. But strategically, it is a play for attention.
They are fighting for eyeballs.
They are. They know that as linear TV, cable news continues to decline, those ad dollars and those eyeballs have to go somewhere. They want to capture the audience that wants video news, but wants it from a trusted source, not a random influencer who might be making things up.
Speaking of capturing audiences, I loved the detail about how they are handling password sharing. We have seen Netflix and Disney crack down so hard on the stick approach.
Oh, yeah.
Blocking devices, showing error messages, basically saying pay up or get out, but the Times is doing something different.
They are using the carrot. They call it the family plan.
Right. So instead of punishing you for sharing your password with your mom, they are encouraging you to upgrade.
The logic is fascinating. They realized that their products like Wordle or a recipe are inherently social. You want to share your score. You want to share the meal you made. So the family plan allows subscribers to pay a premium to legally share access with their loved ones.
It changes the dynamic completely. It's not, you're stealing from us. It's, hey, bring your family in.
And it drives engagement. Because now your mom isn't just using your password and messing up your algorithm. She has her own profile. She has her own game sets, her own recipe box. It brings new people into the ecosystem very efficiently.
And I assume it helps that ARPU number we talked about earlier.
Big time. It's a higher price point. It's a very, very clever way to monetize sharing rather than criminalizing it.
So we have all this good news. Subscribers up, ads up, strategy is working. Why on earth did the stock drop 6.5% this morning? If I'm an investor, I'm just confused.
It comes down to the old adage, more money, more problems. Or in this case, more profit, higher costs.
Okay, break down the cost for us. What happened?
Adjusted operating costs rose 9.7%. That was significantly higher than the guidance they gave Wall Street, which was around 6 or 7%. In the financial world, when you miss your cost guidance, even if you made more money, investors get nervous.
Sure.
They start to worry about margin compression.
But why were costs up? Was it just that big video investment?
That was part of it. Ramping up video production is capital intensive. But the biggest driver was actually success. It was incentive compensation, bonuses. Because the company performed so well, beating revenue targets, beating ad targets, they had to pay out higher bonuses to their employees.
So the stock dropped because they did too well.
In a weird circular way, yes. It is a good problem to have from an operational standpoint. But algorithms and day traders focus on the margins. If costs rise faster than expected, it eats into the profit margins slightly.
I see.
But long-term investors usually look past this. It's a one-time true-up for a great year.
There was also a note in the CFO's commentary about a change in how they are going to report their numbers going forward. This felt a little convenient to me.
This is a critical thinking moment for the listener, for sure.
Yeah.
CFO Will Bardeen announced that starting next quarter, they will stop reporting the breakdown of specific subscriber types. So we won't see news-only subscribers versus bundle subscribers anymore.
Right.
They're just going to report one number, total digital-only subscribers.
Now, the corporate line is that they view the business as one monolithic product. They want us to see the whole, not the parts.
That is the narrative.
Yeah.
And, it's true. They are managing it as a bundle. However, if you put on your skeptic's hat, An analyst might look at that and say, well, what are they hiding?
Usually when companies stop reporting a specific number, it's because that number is going down.
Bingo. It likely obscures the fact that standalone news subscriptions are probably declining. Fewer people are signing up just for the news. If news only is shrinking while bundle is growing, collapsing the numbers hides that decay. It simplifies the story, sure, but it definitely reduces transparency.
It signals that the transition is complete. The Times is no longer a news subscription with some add-ons. It is a bundle company, period. That is a huge shift in identity.
It is. It essentially admits that news alone isn't the growth engine anymore.
Before we wrap up, we have to talk about the elephant in the room for any media company in 2026. AI.
Yeah, it's the headwind and the tailwind simultaneously.
Let's start with the cost. I mean, they're literally spending millions suing AI companies.
They spent $3 million in Q4 alone on what they classify as generative AI litigation costs. They are fighting a very expensive legal battle to protect their copyright against large language models, the AIs that want to train on their journalism for free.
That is real money. $3 million in just 1/4 on lawyers.
It is. But they view it as an existential investment. If AI can freely regurgitate Times reporting without a subscription, the value of their product drops to zero. They have to fight this. But there is a flip side.
The low trust environment we mentioned earlier.
Exactly. Think about the concept of the synthetic web. As the internet gets flooded with AI-generated content hallucinations, deepfakes, SEO spam verified, human-created journalism becomes a scarce resource.
And scarcity drives value. It's basic economics.
Right. The Times is betting that you will pay a premium to know that a human being actually went to the war zone, or actually tested the toaster, or actually sat in the courtroom. In a world of fake, real becomes a luxury good.
So AI makes their product more valuable by polluting the rest of the ecosystem.
That is the cynical but likely accurate view. And of course, they are using AI internally to improve that ad targeting and streamline operations. So they aren't Luddites, they are just protective of their IP.
Looking ahead to 2026, the guidance looks pretty strong.
It does. They are expecting continued growth in revenue, profit, and free cash flow. They even raised their dividend to $1.23, which shareholders always love because it puts cash back in their pockets.
And Meredith pointed out a nice symbolic convergence. 2026 is the 250th birthday of America and the 175th birthday of the New York Times.
A big year for history, and a big year to prove if this model is truly sustainable for the next century.
So let's bring it all home. We have seen a 175-year-old newspaper successfully transition into a digital powerhouse. They have monetized attention through games, sports, and cooking, which is effectively subsidizing the very expensive business of global reporting. They are defying the ad market slump through data, and they are pivoting hard to video to capture the next generation.
That is the summary. They have built a moat made of word games and first-party data.
But as we close out, I want to leave you with a thought. As the Times leans harder and harder into this lifestyle bundle, and as they stop reporting those standalone news numbers.
Here is the question I am mulling over. Is there a risk that the journalism, the thing that gives the brand its prestige, is slowly becoming just a lost leader for a gaming and cooking app? In 10 years, will the New York Times be a gaming company that just happens to have a newsroom attached? Or is this bundle strategy the only way independent journalism can actually survive in the realities of 2026?
A fascinating question to consider next time you open the app to play Wordle. Thanks for joining us on this deep dive into the business of truth and subscriptions. We will see you next time.